The following BLTV program is brought to you by O'Flaherty Law. Please enjoy.
Welcome to Learn About Law. My name is Kevin O'Flaherty from O'Flaherty Law, and today we're going to explain irrevocable trusts for estate tax planning, gift tax, and gifting strategies. So there's a lot of foundational articles and videos we've done about irrevocable trusts, estate tax, gift tax. This is kind of the culmination of those videos, and it relies on a lot of the fundamental concepts we've already discussed in those videos. So you can go to learn-about-law.com to get some background information here. We'll give some summaries of the stuff we discussed in those videos. But this is really the opus of estate tax videos that we're doing. This is what brings it all together. And we'll try to make it as understandable as possible. It gets a little bit complicated, which is why lawyers exist, but we'll try to simplify it as much as we can for this video. So, estate tax and gift tax, let's explain how that works. Estate tax is a tax on the assets of a deceased person over and above a certain threshold. That threshold is $4 million for Illinois, it's $11.5 million federally. Gift tax interplays with estate tax because any gifts that you give over the course of your lifetime over and above $15,000 per year per person, so you can get $15,000 per year per person without any gift tax consequences. Any gifts over and above that annual exclusion amount serve to reduce the threshold at which estate tax kicks in. So let's back this up. So $4 million is the Illinois threshold. If you give a gift of $1,015,000, you're $1 million over the $15,000 annual gift tax exclusion. So now that $1 million gift that you gave over and above the exclusion has gift tax consequences. But gift tax doesn't automatically just apply to that gift. It's not necessarily automatically taxable. What happens is that your lifetime exclusion for estate tax and gift tax is reduced from $4 million to $3 million because you gave a gift of $1 million over and above the annual exclusion. So this is, what's important to understand here is that the gift tax and estate tax threshold for where they both start kicking in is unified, and gifts over and above the annual exclusion reduce this threshold over the course of your lifetime. So now if you've given that $3 million gift, rather than estate tax kicking in at all assets above $4 million, it kicks in at all assets above $3 million. And I think I said $3 million gift, that meant $1 million gift. So that's the rub, is that you can't just kind of give away all your assets over the course of your lifetime in order to remove them from your estate to avoid estate tax, because giving away those assets will reduce your estate tax exemption and cause estate tax to apply at a lower and lower threshold. So this is where irrevocable trusts come in. An irrevocable trust is an entity that can own property separate from its creator, and the assets transferred by the creator, also known as the grantor, into the irrevocable trust are not part of the grantor's taxable estate. That's good, right? The downside is that assets transferred to an irrevocable trust are generally subject to gift tax. And furthermore, assets that are transferred to an irrevocable trust, unless you structure it right, don't get the benefit of the $15,000 annual exclusion. Meaning that, here's the deal, the annual exclusion only applies, you only get to transfer that $15,000 a year to somebody if they have a present interest in that gift, meaning they have actual control of that gift right away rather than down the road whenever the trust pays out. So if you theoretically transfer $15,000 to an irrevocable trust or less, without setting it up right, you're going to pay gift tax on that $15,000 even though it's below what would otherwise be the annual exclusion. We solve this with something called crummy powers. So the way we do this is we transfer the $15,000 to the irrevocable trust, and the trustee sends a letter to the beneficiary saying that they have 30 days to withdraw that money if they want to. And there's an understanding between the beneficiary and the grantor of the trust that they're not going to actually withdraw the money. So every time this $15,000 annual amount is transferred to the trustee sends out this thing called the crummy letter saying, you can withdraw this money if you want, and that satisfies the present interest gift requirement, meaning that the $15,000 or less transfer to the trust is not subject to gift tax, and it's also removed from the estate for estate tax purposes. Well, you could just give that gift to somebody outside of an irrevocable trust and it would be removed from the estate. So why put it into a trust? Well, the reason to put it into the trust is now you've removed that $15,000 from your estate. It doesn't have any estate tax or gift tax consequences. And while it's in the trust, it can accumulate in value over the lifetime of the trust until the trust declares that it passes away, or until either you pass away or for some other reason the trust is supposed to pay out the money. The accumulated value over the annual $15,000 gift you make is not part of your taxable estate. There's no gift tax or estate tax ramifications. So that includes income, it includes rent, it includes interest, it includes any increase in fair market value. So in theory, what you could do is just over the course of many years transfer $15,000 a year per person into this irrevocable trust per beneficiary and allow that to accumulate in value through your investment, and you've still got some control over it, and then you've transferred something out of your estate and the accumulated value isn't part of your estate, rather than if you were controlling that money the whole time in your individual name, any increase in value would be also part of your taxable estate when you pass away. But that's not really how people usually use these things. One way to use irrevocable trust is to make the transfer of more than the annual exclusion. Let's say you've got $1 million business, you transfer $1 million business into the trust and allow that much larger asset, even though it's reducing your estate tax exemption, to accumulate in much greater value over time. It's not necessarily just $15,000 a year. One strategy is to transfer $1 million asset or a larger asset into the trust and take advantage of that accumulating value. But the more common way to take advantage of an irrevocable trust is something called a leveraged gift. And this is often done through irrevocable life insurance trusts. So what you do is you have the irrevocable trust own a life insurance policy. You pay $15,000 a year to cover the premiums of that policy. And now when the policy pays out, it's got a death benefit of multiple millions of dollars that get paid to the beneficiaries named on the policy, free and clear of estate tax. If you were just buying a life insurance policy and it wasn't in an irrevocable trust, the death benefit of the life insurance policy would be part of your taxable estate. Because it's in an irrevocable trust, you are basically transferring $15,000 a year tax-free, both gift and estate tax, to give a tax-free benefit much larger than the sum of its parts in the life insurance death benefit at the time of your death. And that death benefit will now transfer free and clear of estate tax. There's also other uses for irrevocable trusts. One use is it's something called GRITs, GRATs, and GROOTs. These are grantor retained income trusts, annuity trusts, and unit trusts. GRITs, GRATs, and GROOTs are something that we use to allow the grantor to have an asset accumulated in value while still getting paid an annuity or income or some other amount annually from the asset. So we can do this for a business. We can transfer a business to the trust. The only taxable amount, like I was talking about earlier with the $1 million transfer, the only taxable event there is the value of the business at the time it's transferred to the trust. But the business can earn income, accumulate in value, and all of that can be kept in the trust, and that can transfer estate tax and gift tax free. All the while, the grantor can get annual payments from the trust, so whatever they would be getting out of the business anyway for income, they can continue to receive income while the business grows in value, free and clear of estate tax. So that's one strategy. Another reason to use irrevocable trust, and it's often done in real estate, is to remove a real estate asset from your taxable estate, or the accumulation of value from in that asset at least, but you can retain certain rights in that asset. You can retain the right to live in that property for the rest of your life. You just can't sell it without the sign-off of the beneficiaries. So there's lots of uses, but basically irrevocable trust can allow assets to accumulate in value while being removed from your estate free of estate tax and gift tax, and also allowing you to have some control over how those assets are handled during your lifetime and afterwards. So if you have any questions, you can leave them below this post in the comments section at learn-about-law.com or below this video on our YouTube station. If you found this helpful and would like to be informed of our daily article and video topics, please subscribe to us on YouTube, iTunes, and SoundCloud. If you need some help, give us a call at 630-324-6666. That's 630-324-6666. We offer free consultations, and we have offices all around Chicagoland for your convenience. Thank you so much for watching and listening.
Thanks so much for watching our video. If you have any questions, feel free to comment below. Click the subscribe button for new videos every week, and download and review us on iTunes. Visit learn-about-law.com for other legal-related articles and videos. Visit our business podcast and video blog, seizeyourbusiness.com, and visit Making Real Estate Fun for real estate videos and podcasts. Call us at 630-324-6666 for a free consultation.